This is the only video you'll ever need to begin to understand what the stock market is for absolute beginners. So back in the day when the Dutch used to rule the world, they used to have one of the best shipping companies across the world, where they were able to make really big ships and ship them around the world, where they discovered new countries, stole a lot from them, brought them back to the Netherlands, and essentially the gross domestic product of Netherlands, or whatever it was called back in the time, was a lot higher, because what gross domestic product is how much of things, like physical things, that you can produce and sell in an economy. So as you can imagine, the Dutch economy became stronger and stronger because of their amazing naval capacity. So these ultimate ship journeys were actually funded by the government, and at one point they needed to expand the amount of ships they had, which means they needed more capital, they needed more money. Where on earth were they supposed to get this money from? So what they did was they asked random people, if you pay this much, we're going to go across the world, there's so much money, there's so much gold that we can bring back, and as a return of your favor, we're going to double it, we're going to triple it, and this is pretty much guaranteed. Here is a paper that you can keep, and in return you will get some of your money back plus some more. So inadvertently, the Dutch had invented what we know now as investing. So flash forward today, investing works in the similar principle. You as a normal person can put some of your hard-earned money into a company. The company then uses that money to expand, to make more materials, to make more services that they can sell and gain a bigger profit. And in return, you are entitled to a share of that profit. The more shares you have, the higher that profit will be. And today's world is a bit more complex than before, because now we have thousands and thousands of companies over many different stock exchanges, such as the New York Stock Exchange, London Stock Exchange. So we have like the Nasdaq, FTSE, all these things that you don't really need to know as a beginner. But because we have so many thousands of companies all battling it out, the value of the stocks of different companies is very different. And this is where people make their money, by buying something that has value and grows in value, and in the future you can sell the value of the shares that you hold for a profit. That makes you money, and that is essentially how investing works. So as a beginner, I understand that most people don't even know where to start when it comes to investing. For my case, I certainly did not. I only started investing last year after watching Ali Abdaal on YouTube, and honestly that was probably the best thing that I ever did in my life. There is so much information about investing that I, for the longest time, thought that investing was a scam, it was a Ponzi scheme, all these negative things that you see of people losing their money, and it was just something that I thought, it's just gambling, it's not worth my time. But the more I understood investing, the more I actually put my money into stocks and I understood how the market works, the more I realized that I should have started earlier on. One of the things to know about investing is that investing is never a short-term thing. The value of the total stock market, so all the companies in every different stock market, always tends to go up as a function of time. Now on its journey to going up, it's going to go through dips, some major dips, so sometimes it can drop 50% in like a few days. This is where investors get really scared, because they don't want to see the value of their money, so the value of their portfolio, going down by 50%. So imagine you put in your hard-earned £100, which is a lot for a lot of people, and the next day you see the value is £50. You're going to want to sell, and essentially you've just lost. You just lost. You press the button on a loss of 50%, which is not good. But like I said, as a function of time, the stock market always goes up. And the reason why it goes up is because the GDP, like we talked about before, of the entire world always increases. There are more people, there are more needs, and humanity is always driven to make more advances. So I am actually professionally an academic. I've got a PhD, so I kind of work in the whole biotech space, and I know that people are always trying to strive for more. There are always going to be more discoveries, more cures to diseases. And just take this for example, the average life expectancy has nearly doubled since 100 years ago. Think about that. So people are living longer, people need more things are getting more automated. Before we rely so much on primary industries like farming and things like that. Now a lot of it is automated, so now the industries are moving, basically meaning that the gross domestic product of the world is going to continue to increase, meaning that the value of every stock, well, every good stock, every stock that's left over, is going to go up. So as a beginner, you shouldn't worry about the dips that occur in an investing market. However, one thing to note is that definitely your capital is at risk. So you're always at risk of losing your money. However, there are ways to mitigate risks. A famous investor once related driving to the stock market. If you don't know how to drive a car, you drive a car, there is just too much risk and you're pretty much going to crash. However, if you've learned how to drive a car, there's always going to be that risk that you're going to crash. However, you know how to drive the car, and in most cases, you're going to be fine. And that is how the stock market works too. So the thing about stock market is that along the way, like I said, there's going to be dips. Along the way, some companies are going to go to zero, which means that all the money that you put into that company is at risk of going to zero and you losing every single penny. This is why when you invest, you don't invest in one company. Only the most perfect investor will invest in one company. The perfect investor doesn't exist. We're human beings, that does not exist. If you knew that, for example, Apple would go to $1 million per share, you're only going to invest in Apple, because if you invest in another company, you're splitting your money up into two different pots and therefore you're halving your potential profits. It just doesn't make sense. Because no one's a perfect investor, no one knows where the stock market is actually going to go. What you want to do is you want to diversify, which is put your money in a range of different stocks. This could already sound very complicated, but luckily in today's world, there are things called ETFs, so exchange traded funds. An ETF is basically a collection of many different stocks that tracks, so that keeps the performance of a certain group of stocks. For example, you may have heard of the S&P 500 in the US, which tracks the top 500 companies in the US by market cap, which is basically how big they are, how much money they have invested in from their shareholders. So by investing in just one ETF, and most investors agree that just by investing in the S&P 500, you have a piece of the top 500 companies in the US. So even if 10 companies, 20 companies, 30 companies all fail, which is very, very unlikely to happen at that scale, you're still going to be left over with a lot of money, and in the future that can grow and grow and grow. So essentially, as a beginner, you don't want to put your money into individual companies unless you're so certain that you believe in this company is going to be profitable in the future. The thing is, you don't know that, so the best thing to do is probably to invest in an ETF. So you may be wondering, fair enough, now we know a bit about the stock market and we know that ETFs exist, but how on earth do I start investing? So there has never been an easier time to start investing than today, and it's only going to get easier and easier. The reason why I hadn't personally started investing before is because stockbrokers, so companies that actually sell you the shares of other companies, they're called the stockbrokers, they used to charge a lot of fees, which means that these fees used to cut into the profits, meaning that it wasn't really worth investing because it cost so much. But today there exists many different companies, especially in the UK, that will charge very, very low fees. So as a beginner, I would only really recommend around 4 companies that you can sign up to today and put your money in. I will leave a link in the description down below where you can sign up, and some of these are affiliate links, which means that if you do sign up, you might receive a bonus from me and I'll receive a bonus too. So namely, some of these in no particular order are Vanguard. Vanguard is very good. It doesn't have a mobile app. On purpose, it doesn't have a mobile app, and I'll come back to why that is. There is Trading 212, which has very low fees and has a mobile app and is quite easy to use. There's Free Trade, which is very simple to use, has a mobile app. And then there's InvestEngine, which is quite similar to Vanguard in that it is forget it and leave it. So the reason why something like Vanguard or InvestEngine is good is that you put your money in and you forget it and it grows as a function of time. What you should do as a investor is to regularly just keep adding money whenever you can, preferably monthly. So now you have one of these apps, so it's up to you which one you want to go to. There are videos online. I'm not going to go through them on this video about the different types of providers, but now you have a stockbroker. Now you can buy ETFs or individual stocks. What do you do now? You may be thinking, I don't have £10,000 to invest in a company. What's the point? I only have around £50 after the month is done. Is investing even worth it? So this is the biggest misconception that comes to investors, is that they think that they need thousands and thousands of pounds to start investing. This is actually no longer the case, because companies such as Trading 212 and Free Trade, you can start with as little as £1. Also, you might be thinking, what on earth is £1 going to do? Even if the stocks went up 100%, that only really means another £1. Well, the thing is, once you start investing, you realize that there is so much more potential, so much more money to be made, and honestly the first step is to put that first amount in. That's how it started for me. I think I put in £100, and within the next week I think I put £10,000 in, because I just realized how powerful investing actually is. So I've made actual guides on my channel on how to actually invest. This video is not so much about how to invest, but more about the stock market. So right now we are actually going through an economic hurricane. The stocks have plummeted down and it seems like the best time to stop investing. And this is where I'm going to tell you that there has been hundreds of reasons in the past to why you should stop investing or why you shouldn't start investing. But over the long term, like I said in the beginning, over the long term, the stock market will always go up. The period that the stock market no longer works is the period that money no longer works. So actually nothing else matters. All the money that you have in cash or gold doesn't matter anyway. That would mean there is a full economic collapse. So there's no point of worrying. The stock market will always go up as long as money is working. So that means even if the markets are going down, so even if the value of your investments is going down, you should keep adding money into an ETF that you believe in, for example the S&P 500, because when the value is down, it means that when the value goes up, you're going to make more profit, right? At the same time, most people invest when the value is going up, which means that the value is going to go up and then there's going to be another crash or a correction. So like I said, the stock market always goes up, but there's always going to be dips. There's going to be some big dips called crashes, and there's going to be some not so big but very big dips called corrections. This is always going to happen, but the corrections and the dips are the best time to keep adding to your portfolio, keep investing, and in the end you are going to come out victorious. Remember, investing is definitely not for the short term. Investing is not 1 month, 2 months, 1 year, 2 years. We're talking about 10, 20, 30, 40 years. If you stop investing for a while because you think that the stock market is going to go down and you stay out of the market, you are almost guaranteeing that you're not going to make as much returns as if you would have kept on going and invest consistently. Down in the comments down below, I'm taking questions from anyone. No question is stupid. I understand that you are beginners, and if this video didn't make sense, I am going to address every single comment. Make sure to check out some of my other videos, and I will see you in the next video.